Major spending on artificial intelligence drove corporate debt sales to near record levels in 2025. So the question becomes, will that trend continue this year? And what does it mean for investors? Joining us now to discuss is Rachna Bhatt, VP and Director for Investment Grade Credit Portfolio Management with TD Asset Management. Rachna, great to have you back on the show.
Great to have you back and Happy New Year.
Happy New Year to you too. We had an interesting 2025. We probably have an interesting 2026 ahead of us. Let's start with a little report card about how 2025 played out, how you would describe the year that just wrapped up.
Absolutely. And when I think about 2025 and investment grade corporate credit market, the phrase that really stands out to me is exceptional resilience. And that's despite the fact that going into 2025, the spreads, which is the extra compensation you earn for owning corporate bonds instead of government bonds, that compensation was already pretty low. So you would expect that spreads will be a little more sensitive to any sort of negative shocks. And by the way, we got quite a lot of those through the year, whether that was tariffs, whether that was all the back and forth on it, credit wobbles, the labor market data that had started to show up in the second half. Credit really stayed resilient, if you will, versus even the other risk assets, call it equities. As a portfolio manager, you would want to lean underweight at those levels because they're historically very low. But if you did that, it would have been a mistake for 2025 because, again, there was a lot of resiliency in the market, and that's what we saw.
So we see that resilience, but now when you talk about that extra income you earn from the credit, from the corporate bonds, those credit spreads, right now they're even lower than they were in 2025. Yet you still say corporate bonds are an interesting place to be taking a look. Walk me through that thinking.
Yeah, maybe first I'll talk to what created that resiliency, and if we can bring up the chart that I brought here with me. The big reason for that resiliency has been, if you look at this chart, it's been those yields. Look at the chart, and you'll see the yields are historically still very elevated. So imagine earning 4 to 5% in almost guaranteed returns, because this is a very strong asset class, or safe asset class, if you will. So for the safe asset class, you're earning 4 to 5% in yields, and that was a pretty attractive value proposition for investors. This was at the same time in 2025 where the economic backdrop was quite friendly. It was better than feared, despite those tariffs. You had corporate fundamentals looking strong, you had earnings coming out strong, so that demand was on fire from many kind of investors. You saw some of the strongest inflows in the asset class in 2025, and that's exactly what drove this resiliency. But the other interesting observation, and I'm still sticking to 2025 and we'll get to 2026, the other interesting observation about 2025 was credit was resilient. But if you look at US investment grade spreads, how much did they fall? Spreads falling is good for price. It's inversely correlated to price performance. So when spreads fall, it's a good thing. But those spreads only fell 5 basis points, so very small. In the context of S&P 500, which was up 16%. So you should question, why did that happen? Well, that happened because we started from a more constrained valuation base in 2025. So as you think about credit spreads and what can drive credit spreads going forward, it's usually 3 things. Fundamentals, so macro and micro. If that's okay, then the corporate bond markets focus on technicals, which is supply and demand. What's happening to bond supply and demand day in and day out? And the third is valuations. And remember, this is a mean reverting asset class, which is the spreads gravitate towards long-term averages. It's unlike equities, which is a trending market. So as we head into 2026, that valuation is now a lot more constrained, as you mentioned, than it was in 2025. But corporate markets are still the way to go in 2026. You just need to pick the right spots on, in the credit market.
Let's talk about some of those spots, though. Where obviously a big spot last year was artificial intelligence. A lot of money being raised out there. A lot of supply. Even for this year, some of the projections I've seen are very big in terms of how much supply could come on the market. Are you concerned about that at all?
Yeah. So if now we think about the 2026 backdrop, for what our expectation is for 2026, as I mentioned, the spreads right now are quite constrained. The valuation is very constrained going into 2026. So it's still not the reason why you would be underweight credit, and we'll build the thesis on it, and then we'll talk about AI as well. So when you think about 2026, let's go through those three factors: fundamentals, technicals, and valuation. So if you look at fundamentals right now, or for 2026, we can argue, broadly speaking, the economic, corporate, and the rates backdrop looks reasonably supportive for at least the first half of 2026. Corporate balance sheets are in exceptional and very solid position coming into 2026. Now, the issue actually comes from the fact, you mentioned AI, the supply equation, the technicals. Now, if you look at this chart again here for a moment, you'll see that the yields have actually fallen from where they were at the start of 2025. This means that this backdrop is very friendly for the companies to be issuing more bonds. They're leaning into this constructive backdrop and saying, well, we can now pursue more M&A, which we haven't been able to do for the last 2-3 years because of the uncertainty. Also, the AI capex, that's transformational. So all of this supply can start to show up and continue to be a headwind for the bond market. But at the same time, your demand is coming off of the peaks because, again, the resiliency was driven by the yields, and those yields have fallen a little bit.
So it sounds like it's manageable. Right?
Correct. Yeah. So when you think about, again, the 2026 backdrop, we are expecting modest widening from how we think about 2026. But even with that widening, for context, the extra income you earn from corporate bonds can actually absorb some of that widening. And it's a reasonable base case, if you will, for us that there could be some widening because of that technical headwind and how the valuations are a lot more constrained. And it could bring some sector dispersion. It could be the tech sector, which we've seen a little bit over the last year as well. And it could be, even consumer sector or healthcare, which is pursuing more M&A, and we see a lot more supply. But again, we still don't see risk on the fundamental side because this re-leveraging, if you will, is happening from a point of strength. Balance sheets, as I mentioned, are in a great place. So a meaningful fundamental problem is unlikely just yet. So it wouldn't be a major driver of spreads for this year, but it's something to watch.
So unlikely just yet, but there's always risk. So when you're doing that risk exercise, what are you looking at?
Yeah, so when we look at the risk exercise, obviously the biggest theme right now is AI. And that's because all the spending that's happening towards AI, think about all the capex that's going in, it's actually creating, major fundamental structural shifts in how the businesses will operate, in how the labor market will shape in the years that we see ahead, as well as how the new industries that get created from this AI boom. But the other problem is the negative as well, and there could be negative on the fundamental side, but there's also a lot of financing that is needed for this AI call it investment cycle. And that funding needs to be spread across the capital, the entire capital market will need to participate in this funding, which means the tentacles are spreading across different markets. And that, to me, is very important to be focusing on. It's both aspects. So AI is going to be a very, very important theme that markets focus on in the years to come, which means there'll be a lot of volatility around AI-related headlines, good or bad. And you want to make sure you're doing the homework to be on the good side of it, not the bad side, because there will be losers and winners despite whether it's a boom or bust AI cycle, and you need resources for that. So if I think about the risks at the moment, the upside risk, again, because AI is such an important theme, it will come from the fact that upside is, let's call it price upside for corporate bonds, if AI abilities outpace expectations. If that supply expectations that we went into this year expecting that there'll be so much supply and market, investors are positioned for it, what if we don't get that supply? What if it underwhelms? That's a positive for spreads as well, because again, the technical backdrop, the demand backdrop has come off of the highs, but it's still pretty strong. And the third is the positive that I see is, if you have just, very strong growth backdrop, natural disinflation, AI is steady or doing well, the theme around that. The downside, obviously, is, again, related to AI. What if you see some headlines that are negative, that are bad, related to data center build-outs? The second thing is, what if that supply is to the upside? What if there's a lot more that needs to be funded, which is not baked in just yet? And the third is inflation. So what if the inflation risks come back? So these are the three things that we believe could drive spreads to be, our base case, as I mentioned, 10 to 15 basis points wider spreads from here. Canada is a wild card with USMCA. We have to see how that shapes up. Also, Venezuelan oil is not really great for Canada. So some things to think about for Canada with where valuations are. But broadly speaking, I think 10 to 15 basis points is a reasonable base case for widening. And as I mentioned, there are some upside and downside risks to that base case.